Here's a $285,000 duplex I looked at last month. The listing said it would produce $312 a month in positive cash flow. The seller sent me a pro forma showing a 7.8% cap rate. On paper, this is exactly the kind of first deal a new investor dreams about. I passed on it. Not because the property was bad, it wasn't. Not because the market was bad, it wasn't. I passed because when I actually underwrote it, using my own numbers instead of the seller's, the deal didn't cash flow. It bled $200 a month. In the next 20 minutes, I'm going to show you exactly how the seller's numbers and the real numbers diverged, line by line, on the same spreadsheet I use on every property I evaluate. If you've ever looked at a deal and thought this seems too good to be true, this video is going to teach you how to prove it before you sign anything. Here's the single most expensive mistake I see new investors make. They read the seller's proforma, they plug those numbers into a mortgage calculator, and they buy a property. The seller's proforma is not an underwriting document. It is a marketing document. Every number on that page has been chosen, carefully, sometimes honestly, sometimes not, to make the deal look as attractive as possible. Rents are shown at the top of the market range. Vacancy is assumed at 3 to 5%. Maintenance reserves are shown at $50 a month, which is the number no operator I know actually uses. Property management is often left out entirely because the seller is self-managing. And property taxes are shown at the current assessed value, which is going to reset the day you close. Every one of those assumptions can be individually defensible. Add them together in the wrong direction, and you have a deal that cash flows on paper by $300 and drains cash in real life by $300, a $600 swing per month per property. That is not a rounding error. That is the difference between building wealth and unwinding a mistake for the next 5 years. The investors I've watched succeed over 23 years, the ones who own free and clear properties today, do not use seller proformas. They build their own, and they build them with the assumption that everything the seller told them is wrong until proven right. So let me show you what that actually looks like. The deal on my screen right now is a real duplex I looked at last month. I've anonymized the address, but every number I'm about to plug in is the actual number I pulled from the actual listing. 2-unit duplex, built in 1998, 27 years old at the time I'm recording this. Each unit is 3 bedrooms, 2 baths. Total square footage is roughly 2,800. It's in a working class neighborhood in a mid-tier Midwest market. I've owned properties in markets exactly like this one for over a decade. Asking price, $285,000. Seller's stated rents, $1,200 per unit per month, $2,400 total gross monthly rent. Seller's pro forma cap rate, 7.8%. Seller's projected monthly cash flow after debt service, $312. At this point, most investors would run this through a mortgage calculator, see that positive cash flow number, and start scheduling a showing. I don't, not yet, because I haven't verified a single one of those numbers with my own research. The first number I always verify is the rent, and here is where this deal starts to unravel. The seller said each unit rents for $1,200 a month. I pulled 3 rent comparables from the same neighborhood in the last 90 days. Same bedroom count, same rough square footage, same age of property. Comparable 1, $1,075 per month. Comparable 2, $1,025. Comparable 3, $1,100. Average market rent, $1,067 per unit. So right off the top, the seller's rents are inflated by about $130 per unit per month. Multiply that by 2 units, and that is $260 a month of gross income the seller is claiming that the market will not actually pay. Now, could I raise rents to $1,200 over time? Maybe, but that is a bet on future performance. My job as an underwriter is to model what the property actually produces today, not what I might be able to squeeze out of it in 18 months if I'm right about the market. Adjusted gross rent, $2,134 per month, not $2,400. Just from correcting the rent number, we have wiped out the seller's stated cash flow. Step 3, property taxes, the reassessment nobody talks about. The next number I check is property taxes. And this one is where a lot of first-time investors get destroyed. The seller's proforma shows property taxes at $2,400 a year, $200 a month. That number is not wrong. That is exactly what the current owner is paying. But here's the thing nobody explains. In most states, when a property changes hands, the county reassesses it based on the new sale price, not the assessment from 10 years ago. In this specific county, the effective tax rate is 1.44% of assessed value. If I buy this property at $285,000, the new assessment is going to move up close to purchase price within 1 to 2 tax cycles. 285,000 times 1.44% equals $4,104 a year, $342 a month, not $200. So the seller's proforma is understating property taxes by $142 a month. That is another $1,700 a year of expense that appears the day I close and never goes away. Step 4, vacancy. The number sellers always lowball. The seller assumes 5% vacancy. That means they're telling me the property will be occupied about 11 and a half months out of every 12 on average. In a hot Class A urban market, 5% might be defensible. In a working class Class B market like this one, not a chance. I ran a vacancy check on the specific submarket using a combination of Rentometer, Zillow observations of days on market for rental listings, and my own experience owning properties in similar markets. Realistic stabilized vacancy in this submarket is closer to 8%. That accounts for tenant turnover, the 2 to 3 weeks between leases when a unit is being cleaned and re-rented, the occasional lease break, and the reality that not every month of the year is equally easy to fill a vacancy. 8% of $2,134 is $171 a month. Step 5, the expenses the seller left off entirely. Now we get to the part that separates hobbyist analysis from real operator analysis. The seller's proforma shows maintenance at $50 a month. Every professional operator I know underwrites maintenance at somewhere between 5 and 10% of gross rents. On a 2,800 square foot, 27-year-old duplex, I use 8%. That is not conservative. That is realistic. Roofs fail, water heaters fail, HVAC fails, tenants damage things, toilets overflow. 8% of $2,134 is $171 a month, not $50. Next, capital expenditure reserves. This is money you set aside for the big ticket items that will fail during your ownership. Roof, HVAC system, water heaters, windows, flooring, exterior paint, driveway. On a 27-year-old property, you should be setting aside another 5% of gross rents at minimum. That is another $107 a month. The seller's proforma has this at 0. So if you are underwriting to their numbers, you are one large capital event away from a real financial emergency. Next, property management. The seller is self-managing, and every seller who is self-managing shows property management at 0 on their proforma. But you are not going to buy this property to become a landlord answering 3 a.m. phone calls. Even if you plan to self-manage, you should underwrite as if you're paying a manager, because that reflects the actual cost of the labor being performed. 10% of collected rents is the market rate, and 10% of $2,134 adjusted for vacancy is about $196 a month. And finally, we have insurance, which I've already verified with an actual insurance quote for the property. On this specific building, in this specific market, it is $148 a month. That one the seller had approximately right, but only because they're on an old policy that's going to non-renew or re-rate the day I take title. Cursor now shows all expenses updated. Total operating expenses are dramatically higher than the seller's pro forma showed. Step 6, the financing reality. Now we plug in the debt. 25% down on $285,000 is $71,250 of cash out of my pocket. The loan amount is $213,750. At today's investor rates for a conventional non-owner occupied loan, I'm looking at 7.5% on a 30-year amortization. Monthly principal and interest, $1,494. Step 7, the verdict. Let's total this up. Gross monthly rent, adjusted, $2,134. Total monthly operating expenses, taxes, insurance, maintenance, capex, property management, vacancy, $1,175. Net operating income per month, $959. That's an NOI of $11,508 annually. Debt service, $1,494. Cash flow, negative $535 per month. That is the deal. The seller told me it would produce $312 a month positive. My underwriting says it will drain $535 a month. That is an $847 swing between the seller's proforma and reality. At the asking price, this property does not work. Not for me, not for you, not for anyone who is underwriting honestly. If this is the kind of walkthrough you want more of, real deals, real math, real verdicts, hit subscribe. New video every week. That is where I break down the next one. 3 key insights. Every number the seller gives you should be treated as unverified until you have verified it yourself. Their rent numbers should be checked against 3 real market comps. Their expense numbers should be replaced with your operator expense numbers. Their tax number should be adjusted for reassessment. If the deal still works after all that, you might have something. If it doesn't, you learned everything you needed to learn in 90 minutes at your kitchen table instead of in 2 years of losses. Those 3 lines account for the majority of the gap on almost every deal I've ever underwritten. If you don't understand how to model them accurately, you cannot underwrite a rental property. Everything else, cap rate, DSCR, cash-on-cash return, is downstream math built on top of those 3 inputs. The value of underwriting is not that you find deals you should buy. The value of underwriting is that you avoid deals you shouldn't. Every rejected deal is one you didn't lose money on. In my 23 years as a broker, I have watched dozens of investors fail, and almost every one of them failed on a deal they should have walked away from before they signed. The discipline is the walkaway, not the acquisition. Anybody can buy a property. The skill is knowing which one not to buy. The spreadsheet I use to underwrite this duplex is the same spreadsheet I use on every property I evaluate. Personal, commercial, single family, multifamily. It's linked in the description below, and it is free to download. If you use it on your next deal and the deal doesn't pencil, you just saved yourself years of pain. And if the deal does pencil, you now have the confidence that comes from doing the math yourself, not trusting somebody else's marketing. Subscribe to Brick by Brick Capital. Every video I publish, I underwrite a real property in front of you. Some of them will work, most of them won't. I'll show you both, because you learn more from the rejections than you will ever learn from the wins. Next Tuesday, I'm publishing the 5 most common mistakes I see first-time rental investors make. I've watched investors lose money on all 5 of them, sometimes on the same deal. One of those mistakes is a mistake I made myself on my second ever rental purchase, and it cost me almost $12,000 before I figured it out. I'll tell you exactly what it was and how to spot it before you sign. I'll see you Tuesday.